Well, hi, everybody. We are recording this today, so you'll be watching us a little bit later. Welcome to another Arizona Realtors Industry Update. We have once again assembled for you experts in the lending industry, and I'm going to let them introduce themselves now. Sherry, please start.
Hi, I'm 𝐔𝐩𝐝𝐚. I'm the Realtor Relations Manager with Define Mortgage, and I'm also a licensed loan originator, with way too many years of experience in mortgage lending. Thanks, Paula.
Absolutely. Jeff.
Good afternoon, everybody. My name is Jeff Ehrlich. I am the Vice President of Operations at Western Alliance Bank for our correspondent type channel. Been in the business a little over 16 years, and I'm a certified mortgage banker, which is the highest honor that you can get with the Mortgage Bankers Association.
Thank you. Jake.
Howdy, everybody. Jake Krabbe. I am the Regional Sales Manager with Academy Mortgage, and I've been in the business 1 year longer than Sherry has. I got her just a little bit.
I like it already. All right. Andy.
Hi, Andy Murcielski with Prime Lending. I'm a branch manager and producing loan officer. I've been doing this for 22 years, and I also serve currently on Prime Lending's National Advisory Board.
Wonderful. We have many, many, many years of experience with us today. We have a lot of questions that have already come in from people that had registered for this event to get through. So let's get started with the topic that's on everybody's mind right now because of news that's come through from Arizona. Sherry, what is happening with RON, Remote Online Notarization? What are you seeing from your end, and what can we expect?
Okay, well, first, everybody, you're going to see me, if you get to watch this live, you're going to see me reading this because we wanted to cover so many of the details that I want to make sure I got all of my notes. So again, good morning, everybody. And again, thank you, Paula. At some point in time when I'm done, you have to do all of your introductions so that we know on the team that we're graced with you leading this. So but let's get on to RON for today. And we certainly have seen, again, as I read this, seen a lot happening since our previous webinar. With Governor Ducey's executive order on RON, we've added very positive momentum to the creation of a virtual transaction where there is no pen to paper. And I'm hoping everybody lets that sink in for a moment. In many cases, there will be no wet signatures for certain loans. And this is really very, very exciting. But where is the go live date, right? When do we make this happen? Well, let's recognize that there are many parts to work out. I will attempt to be as brief as possible. It starts with how do we do this? And we have to look to the Secretary of State to start with. Yesterday, I noticed that the Secretary of State's website has a coming soon announcement regarding RON. And I'm actually going to paraphrase from the website when I repeat that there are steps that must be taken to become an electronic notary and/or a remote online notary. Applications to be submitted and rules to be reviewed. It is expected that the website will be available tomorrow on Friday. So as I share this, from yesterday's information, the links were not live yet, so I couldn't check on anything, but it's important to know that that website is coming. So now I think we need to have a little bit of conversation on this topic to offer some insights. And perhaps as a realtor, you had a cash transaction and RON was used because, there are a number of title companies that have been working with a unique e-notary platform, and they have been successful assisting cash transactions and helping sellers, of course, by using notaries in other states where RON is currently legal. As the push for the next phase of RON is now upon us, I understand more title companies are joining, with those types of cash transactions. Now, it gets interesting because as for us lenders, we also require guidance from the Secretary of State. We need to implement the logistics. We need to maintain all legal responsibilities and requirements. We lenders have added layers of technology that we're not ready for today. that title companies do not have to meet. We need to be able to sell our loans on the secondary market, and therefore we have critical regulatory concerns. If lenders fail the compliance piece, we will not be able to sell that loan. Title companies certainly also have risk ensuring that all the documents are properly executed and notarized as part of the title insurance arena. We certainly have a lot of work to do, but truly the exciting part, the bus is in motion. We will get there. So what about today as we're doing this webinar? How do we put the pieces together? As a realtor, you probably, and as us lenders, have typically experienced what might be called a hybrid RON or a RON hybrid closing. The closing documents are sent to the buyer electronically for review. They can acknowledge, etc. But we still have a meeting of sorts. We still use pen and ink to sign the note and the deed of trust. And truly a shout out to the title companies because they've done an amazing job making that last piece happen, especially in these challenging times with all their notaries getting those live, wet signatures on the note and deed of trust. But we may all be a little bit confused since everybody's thinking, well, we're already using remote online notarization, the acronym for RON, remote online notarization. Well, you absolutely have, but it's been the hybrid version with the wet signatures. And now let's move on to the new or the next level of RON, the anticipated hot topic for today, because now we have the executive order that says, Secretary of State, please tell everybody, what do we have to do? So as we move to the e-note or the e-mortgage, and I'm trying to be really sensitive because the various terms are used and they're interchanged, but what I'm talking about is no wet signature, no pen and paper. This will be a completely different process with layers of security, authentication, ID reviews, and not only a visual, but also an audio recording of the event. It's referred to as a ceremony, if you can believe it. And I'm actually adding a disclaimer here that I'm only giving a sampling of all the steps we have to take. I hope everybody listening or watching at some point in time can visualize this is extremely high technology with layers of security and therefore requires the utmost protection at all levels. I think if we can all go back and remember how wire fraud hit us, please reboot and recognize where we have to get with this new step. So and you know what, before I ask, go ahead.
Oh, I was gonna say, so what I'm hearing from you is really patience, education. There's a learning curve on all levels with this for everyone, right?
Oh, yes.
And to understand that this is not something that your lenders can just flip a switch on.
Oh, correct. So here's what I was going to add and wrap up, and then I'm sure my fellow lenders can add to this. But before I ask for the input on them, recognize everybody has probably experienced a hybrid RON, and you may have been very fortunate where you had a purchase, but it was cash. So therefore, it could have been done by using out-of-state notaries in a state where it's already legal. So going back to what you just said, Paula, now we have the opportunity to take it to the next level, which is truly exciting. We've all known it's coming, but I can only ever ask everybody to please exhibit patience. We need all the details. We need time to execute. And the way I look at it, even the Secretary of State might be a little busy as all those applications roll in for people to, meet their criteria. So thanks for the opportunity.
Yeah, that's so important. Does anybody have anything that they feel they need to add, or can we go on to the next topic? Because we don't have as much time as I'd love to have with you guys. Ready to go on? All right, because I think that is the big thing that's on everybody's mind. We'll probably maybe see some other questions coming up about that later. I kind of like to look at this from going through the steps as a realtor. So the first thing we're going to be looking to do is get our people approved. So Andy, what are you seeing as far as changes in FICO requirements, debt to income? What kind of changes can we expect to see? Can we prepare our clients for?
Well, it's important to recognize, thank you, Paula, it's important to recognize that there's difference between what's going on in the industry and how lenders are implementing it, because Fannie Mae, Freddie Mac, FHA don't lend directly, they lend through mortgage lenders. So they'll set guidelines and then mortgage lenders are going to make some of their own decisions in regards to how to manage risk. Generally, you've seen credit scores on FHA loans go up. I don't know, I mean, you see a lot of lenders, at least a 640, probably 660, 680, that'll continue to change. The reason is there's a lot of unintended consequences on this forbearance program that's been put in place. But the thought is if the FHA buyer is probably more likely to start missing payments, lower down payment, maybe marginal credit, so they might stop making payments. So you've seen some of that. Debt to income guidelines a little bit. Again, it's going to be really depend more on lender overlay on what you see as far as debt to income ratio. You might see some reserves added. For example, FHA added reserves that wasn't there before. So you'll see a little bit more conservative move.
And one of the questions we actually got from the registrants ahead of time was, is FHA as we know it going to go away?
Not at all. Nope, nope. You'll see some changes, probably temporary changes.
Everybody's nodding their heads no. Yeah, no. See some changes.
Temporary
Changes. Okay. And then Jake, regarding the verification process and being prepared to send in docs and maybe not having access to the IRS, what can we best do to prepare our clients with that scenario right now?
Well, thankfully, it seems like all of the agencies are rapidly giving relief on documentation requirements, and every company is going to do their own due diligence on what is going to make them the most comfortable. When it comes to the specific agencies, though, we've seen things like tax transcript relief, where the tax transcripts aren't being required in any cases. We're actually seeing that with even the bond programs, FHA loans as well. One of the big pieces is that verification of employment, and you really are seeing companies step up the frequency of times that they're verifying this employment, and they're shrinking that timeline from funding. And what a lot of this all ties back to, and I know Jeff's going to get into kind of the nitty gritty of it, but really a lot of these problems have stemmed from the government coming out and saying, we're going to allow borrowers to forbear their mortgage payments, which is great for the consumer, but it's missing that piece of the bank that's servicing that loan isn't necessarily the note holder. They don't actually own that mortgage in most cases. And just because the consumer is not making their payment doesn't relieve that servicer from making those inline payments. And so there's a lot of uncertainty around this forbearance, and that ties in directly to the verifications of employment. When you have borrowers or buyers that are going to forbear their mortgages before they even make their first payment or within the first 3 payments, there are a lot of covenants in place with the originating mortgage lender and the servicer that forces them to buy that loan back or have to take over or refund any of the premiums that's been made. And it gets really expensive for companies. So a lot of those steps, I think everything's being really sensible right now. I think the amount of disruption overall in the key programs of Fannie, Freddie conventional loans, FHA loans, VA loans, the amount of disruption is fairly minimal, but there's definitely a lot more due diligence taking place.
That is so important for everybody to understand. And, you know, understanding why the due diligence needs to take place. You did a perfect segue over to Jeff for me, which is great.
Hey, Paula, can I add something real quick before
Andy,
you move on to
please
Jeff?
do.
We are seeing relief, you know, like if an employer can't be reached a couple days before funding, that a client can show us their most recent pay stub if you can't get an employer on the phone, or a bank statement that shows a recent direct deposit in order to alleviate, you know, reaching the person at the school district, for example, that isn't there to confirm they're still employed. So we've been able to be a little more creative, to Jake's point. The frequency's gone up, but we can be more creative on how we do it.
So what I love about that is, we wanted to focus on solutions today. So understanding that if there is one way that you cannot verify it, look for another, talk to your lender about it. There's more than one way that we can get that solved for you. That's really good for everyone to hear right now. Jeff, all of this, can you take us up to the bigger picture level right now so that we can kind of see what's happening with the federal rates and what's happening nationally, how that is going down and affecting what Jake was talking about with the verification process and how that kind of comes down to us?
Well, we've got people in the secondary market, like what I do, like what the large banks do, Chase, Wells, et cetera, who are out there buying these closed loans. And really, we put out a set of guidelines. We're looking at those guidelines and making basically a risk decision. And these loans are coming in as an asset for that entity, frankly, for the income stream of the interest rate being paid on that note. That's what banks are doing. If you think you're getting a 4% interest rate on your mortgage, the person who owns it wants a 4% per month of that outstanding balance, and that's what they're looking for. That's income to the entity that owns the note. I mean, the verification part, I think, actually is Andy kind of said, we found a lot of real workable solutions around that and are being able to get creative. To just touch on that, though, from a communication standpoint, I think both this would impact the agents and the loan officers involved, is having some very direct communication with the person who's buying and that borrowing entity to say, listen, it's just not like it used to be for right now. And you're going to be asked many times throughout the process for updated information. I'll tie that up into assets required to close at the transaction. Most of the time you can validate the assets, the funds needed to close, 60, 90, some up to 120 days before the closing, and that's perfectly fine. Well, if that money was tied to the stock market, they may not have enough anymore. So us as buyers in that secondary market, we've said, no, you can't be out 90 days. We need something within 30 days or within 14 days. What this leads to is the borrowers having to continually update critical pieces of information that us in the secondary market look at when we're looking to purchase that loan from the originator. And I just think the key there is that all parties to this transaction just understand that, one, it's stressful. Two, there's going to be a ton of requests throughout the process, and it's because everybody wants to make sure that the diligence is being done. Nobody wants to close a loan and then 3 days later the borrower loses their job and can't make even that first payment. And I think it was, Jake who commented, that could be a repurchase for that mortgage bank. And us on the secondary market, we look at that and go, well, if they can't make their first payment, clearly there was a problem that you should have known as originator. So buy that loan back for me, and that becomes a serious capital stretch for the originating lender.
I think that's so helpful for everyone to kind of understand that different world perspective that we never see on the streets when we're helping our clients. So thank you for taking us through that secondary market view. So the Federal Reserve has lowered the rates, but why aren't they even lower is some of the questions that we're getting. Jeff, can you answer that? Answer for the Federal Reserve right now, Jeff.
Yeah, it's actually a pretty complicated question, and I may raise my hand and phone a friend here because I think Andy's got a pretty good handle on this as well. But the basic premise here is the federal funds rate is an interbank lending rate, meaning if Bank A needs money for whatever, overnight they can lend or get money lent to them from Bank B. That's not consumer rates. And consumer rates are completely different than what the Fed funds are. And so, not to mention, there's basically just a natural basement or floor for any interest rate. As I just commented, that as a bank, when we buy a mortgage loan, we're looking for the income from that loan. at some point it becomes essentially neutral, and we wouldn't really earn any money on a loan. So if you think about putting money out into the market for 30 years at, let's just make a number, 2.5%, well, there is actual real cost of funds involved in that as well. And there would be basically no money to be made for those people in the secondary market. So there's going to be a natural floor regardless of what the Fed is doing. Andy, I know we talked a little bit about this. You want to jump in and maybe give a slightly different perspective on?
Mortgage rates a mortgage is an asset, and mortgage rates are based upon the trading prices of a bond called a mortgage-backed security. And the Federal Reserve right now, the liquidity dried up. Nobody wanted to buy anything for a period of time, including these bonds, which are normally a pretty guaranteed return because people are making their payments. So the Federal Reserve stepped in and said, hey, with no buyers, interest rates are going up. Why don't we start buying these mortgages on the secondary market in order to buying the mortgage-backed securities in order to drive rates back down? So that's what they've been doing. And they started doing about 50 billion a day, but they dropped rates so fast it had some unintended consequences. So rates have come back up and they're doing 20 to 30 billion dollars a day, which is still a huge amount of money. And they're going to continue doing that as long as necessary. And then you're also seeing discrepancies between lenders right now on interest rates because of the servicing component. That when the government, the analogy I give is that imagine you're a shopping center owner and you have a bunch of tenants that pay you rent every month, but you have a mortgage you have to make to your mortgage holder on the shopping center that you own. The government has told the tenants they don't have to make their payments anymore if they don't want to. You don't have to document you have a hardship. You don't have to make your payment. But hey, shopping center owner, we're not giving you any relief on the mortgage you have to make your bank, make the payment to your bank. So that shopping center owner, that's the servicer, and in some case, the mortgage lender. So you may say, well, shoot, I got to start charging my clients a little bit more money that are paying because I know that a lot aren't going to be paying. So based upon your servicing model, you're seeing big discrepancies right now in mortgage rates as well.
That is a great thing for people to know. Go ahead, Jeff.
Well, I know one of the questions that was mentioned was also margin calls. And so Andy made a comment about the bonds and the mortgage-backed securities. Well, when a mortgage lender or an originator takes a locked or accepts a lock, a rate lock, says, okay, Jeff Ehrlich, you have a 4% lock on your loan. We will honor that. You're going to close your loan at 4%. In case rates move, they do what's known as hedging. And I'll try to keep this very high level, but essentially think of a teeter-totter. You've got a pipeline of loans and you've got hedging, and you want them to stay sort of in balance. The hedging strategy is not to make money. It's to offset changes in the mortgage rates. And typically what they use for that are the bonds that Andy was alluding to as an investment vehicle. Well, because rates have been moving around and the Fed was buying these, they didn't normally what they'll do is when mortgage rates go up, bond prices go down. That spread allows sort of this insurance, if you will, for this hedging strategy. They were not moving as we've typically seen them move. And what was happening is, since the bonds were not moving as expected, these guys are using, the capital markets groups and lenders are using, think of like stockbrokers, broker dealers they're called. If you have a stock investment account, you can buy these things on what's known as a margin, which basically means you're good for $100,000. You've got this money setting aside. Well, once your margin or the difference between what you've bought and what you kind of owe goes above what they've already deemed your margin, and that's just another underwriting question, so to speak, they call it due and say, hey, you're at 150,000, so you need to scratch us a check for that 150,000. And that is what was happening, is the two dynamics were not moving as they normally do. And these broker dealers, the unintended consequence here was the broker dealers, these spreads got too big, and the broker dealers said, whoa, you guys are out of your own compliance here. You got to make that right by sending us cash. And that was causing issues. So that kind of helps with the margin call. You can get a lot deeper on that, but I'm probably not the expert on that either. But
I think that helps a lot. I think just understanding the seesaw as you explained it, the teeter-totting seesaw, and when it gets out of balance, they've got to call the margin. When they do that, there's less money. I think that helps everybody to understand a lot. Go ahead, Jake.
Just real quick, too, I really think it's an important point for people to understand that every single mortgage lender has been experiencing this. And the past probably 6 weeks or so now has been completely unprecedented. It's totally different from a lending space than what happened during the last, recession and housing market crash. And there's nobody that's been immune from it. And every company has been making changes and making decisions on a weekly, a daily, and a lot of times even an hourly basis on, do we keep this program open? What do we do with our rates? What are we going to do on locks, purchases, refinance? And everybody's using the most data they have available at the time. Luckily, over the past, I would say about week now, we've seen a lot of this volatility really start to calm down, and people have been able to kind of find their groove. But nobody's immune to it. Everybody's doing the best they can, and it's just important that you ask a lot of questions. If you're unsure about something, you verify information, and just know that there's not one company that's rising above the rest or doing it way worse than anybody else is. We're all in the same boat.
That's really great to know, Jake, and to just understand right now that we are all in this together. This is what's happening. Given what you've said about all the changes, sometimes every hour, sometimes programs drying up, Sherry, when should people be locking? What should people be doing?
Well, I think, and we've talked about this as a group, and the reality of it is, if you are ready, willing, and able to purchase a home, you should be making your best decision for locking based upon your needs, because as Jake already said, and the guys already alluded to, we've seen some, I'm going to say stability, that's a really scary word to use right now, meaning we've recognized what we've just gone through, and everyone has been affected. And I think that in the best of all scenarios, you buy your house, you lock your rate, you move on, and 90 days from now, 6 months from now, with everything we're going through, I don't think we're going to go the other extreme with rates. I'm not quoting rates because I don't have any of those degrees nor crystal balls left. But refinance at that point in time if you really see that that's in your best interest. But if all of us large mortgage companies, or if the government is reflecting this instability, we certainly cannot tell you what's going to happen to rates. So if it's good for you now, buy, lock, close, move on, and then deal with it, down the road, as it appears, as the opportunities occur. There will always be opportunities.
If it's good for you, lock it down. That's solid advice. Sherry, I know we had spoken a little bit before, but can you share with everyone what issues they should be aware of when using the new AAR COVID addendum?
Well, the form is great, and we appreciate the risk management team. Thank you, Paula, and AR from giving us. How you applaud? I'm applauding for them. I know, and we're grateful because it gives us guidance. But as realtors look at that form from a lending perspective, we're seeing them now. But here's our questioning, for lack of a better way of saying it. Sometimes they come with the purchase contract right up front. You're telling us that you're using that form. Other times we see it after you're like a week into the transaction. And you've got a couple of options on that form, and I'm going to try to do this from memory. I think it's, and please help me out, Paula, realtor in the room here, not me. Line 18 is talking about if everyone agrees, because of COVID-19, that you can have up to a 10-day extension. But the key is it does say, and you will close within 10 days. Not go sign your docs. You will close within 10 days. That means everything's done. So really, we lenders would, we may have gained 5 or 6 days because docs have to be there because you're closing in 10 days. So that's phase one. And of course, if it doesn't happen, I guess you're going to follow your process of cure notice or breach or whatever that might be. But then when you get to, I think it's line 24, now it says the same verbiage, about, closing, not signing docs, but it goes on to say you can extend, and you can extend not exceeding 30 days. And then it also says, and either party, pretty much for any reason, can say, we're done. So for we lenders, we're trying to lock a loan. What locking date, what close of escrow date are we using? You've given us the close of escrow date on the contract. So we're going off of that, but then all of a sudden you say, okay, but we decided to extend. Now we have the potential for lock expiration. So on our part, we really need communication. We really need to for that form to be discussed up front so that the buyer and the seller recognize, because there's extension fees. It goes right back to what the guys were just talking about, locking a loan, knowing, that you're going to deliver.
Using the form, using it right up front, making sure everyone's clear what all the terms are. Making sure.
And absolutely, because when you add it at the end, that loan's probably already locked. And now we've got to talk about we need 10 more days or we need 30 more days. But again, by all means, everybody review that form and make sure everybody's on board. And we're all saying the same thing. We need unbelievable communication in these times, just true communication, and be prepared for the unexpected.
So, on that end, what are we seeing as far as timelines for the escrow or for the appraisal? Andy, what are you saying?
We haven't seen too much of a change. I mean, a few days added on to appraisals. I think you have to prepare, though. Like Sherry said, expect the unexpected. Give yourself a little bit more time. I've had appraisers say to me, boy, if you would have given me 10 days, I would have had the order. About a week was a little bit quick for me. So give them a little bit more time. We've seen expanded guidelines on appraisals. So on a lot of loans, if the appraiser doesn't want to go into the property or the current owner doesn't want him in there, they can do a drive-by or do a desktop appraisal. Fannie Mae and Freddie Mac have also expanded their appraisal waiver process. So when a lender puts a property through an automated underwriting system, whether it be Fannie Mae's automated underwriting system or Freddie Mac's, that'll decide whether it does a basic property valuation analysis. And if there's 20% down payment, then that analysis could end up with a waiver, which means you don't have to do an appraisal at all.
Great to know.
Which is a good thing. So 20% down, if somebody's deciding, hey, there's a lot of reasons why you might want to do that, but no, that's a great process.
So 20% down is one of the things that could trigger an appraisal waiver. Are there any others?
On a purchase, there's refinances. You could do it right now. They've expanded it to as little as 10% equity if somebody's refinancing a home and still get an appraisal waiver. What the system is looking at is these are very sophisticated systems. It'll know, hey, maybe Fannie Mae had an appraisal on that property a year ago because the homeowner had refinanced it. So now somebody's buying it. And we had a record of this from a year old, or maybe a neighbor, or an average value in the census tract. There's all sorts of things. You don't know until you run it, but the minimum trigger for purchase would be 20% down.
20% down. And Andy, what are you saying go ahead, Jeff.
I was going to jump in. Andy did a nice job with the Fannie Freddie space. But if you get into the higher markets and into jumbo, there really isn't a mechanism to get an automated waiver. Some of the investors out there are allowing for a waiver or an exterior only. But I was just on a call yesterday discussing our policy and others and what's going on in the jumbo space. And many lenders or many of the investors who buy the jumbo loans are not going to do that. They're still going to require an interior exterior appraisal, because at that kind of a loan amount, if you're talking, I'll just throw a number, $750,000 loan amount and up, and you're probably talking about $1 million properties, you want to know exactly what the collateral is for that loan. Not to mention, when you get into that space, you get, semi-custom or custom built homes. It's very difficult to determine a real value from the outside and not going inside to see what other upgrades and options are there. And as an investor in that space, we're not going to just take an MLS listing. We need the appraiser to actually assert that they saw that and are giving, I gave it this value because of A, B, or C. And so it's a little different in the jumbo space.
And understanding that is really important for people, because depending on which product they're going for, it's going to be a completely different landscape going forward. Yeah.
Yeah. So real quick back on that. So as agents, when you're doing listings and you've got somebody in that space, that's probably a great conversation to have, to say, hey, unless you've got a borrower who's buying it cash or somebody who's coming in with enough money to buy it down to agency level loans, and I forget the number, but 475, as a 475,000 is a loan amount, probably off by a few $100, but if you're up in that space as a listing agent, that's probably a conversation you need to have, that, hey, somebody's going to have to get into your house to actually do an appraisal. So be ready for that when the request comes.
That's a really great tip. Sherry, please go.
Just want to also add, back to the communication that everybody's been talking about. If you start changing loan to values, or if the appraisal amount changes, you can, on rare occasions, lose your waiver. So once again, it's really important to know what you're looking for up front. Have the conversations, have your plan prepared, because that can change things for you.
Go ahead, Jake.
Paul, a couple things. So all great stuff so far with all the appraisals. A couple things to add. FHA and VA have both come out and offered up guidance to accept the same exterior type appraisals, so the full interiors aren't required. I think probably one of the questions that we see the most is, how is this going to affect values? Are my appraisals going to come in low now because it's exterior only? Are appraisers accounting for a market decline because of the things happening with COVID? Few things around those points. With regards to a decline in market values, we really haven't seen anything yet to drive that data. And it's really not an appraiser's prerogative to make assumptions or say, I feel like the housing market is going to decline, or there's the potential that values could be suppressed. So if we're seeing those types of things on appraisals, we're definitely able to give pushback on that. And we want this to be very data driven. Is there marketable data that home prices are declining because of what's going on? When it comes to comparable data, for the most part, most of the data used in the appraisal is just that. It is the specs of the home, the square footage, the bed bath count, the amenities, things like that. So a lot of these tract type homes that are very similar, I don't anticipate to see a lot of valuation issues. When you start to get into your highly upgraded homes, the custom homes that Jeff's talking about, things where you do need to get in there and see it and feel it and really take in the nuances of these homes that might be a little bit more complicated, you might start to get to some valuation issues there without the ability to do that inspection.
This is all really good for people to understand heading into it, so that they know in case there might be friction down the road. If you've got a more custom property and they're talking about doing an exterior valuation, perhaps sending to them information about the house that they wouldn't be able to see from the outside, so they can glean a little bit more information. Again, we're all trying to work together with this and find the solutions to get forward. Really great information to bring up. Thank you so much, Jake. I kind of want to go back into the escrow process again, and we've talked about how we're going to write the contract, make sure that we get the addendum right up front when we're using that, make sure that prior to that people understand that their requirements may have shifted, to be checking in with their lender. And then Jake, you talked about how they're going to be checking back for verification multiple times. Can you give us an example of what that might look like? How many times could we expect, say, in the process, in the span of a 30-day escrow? How many times might they check verification?
Yeah, so I'll give an example of our company and what our current policy is. So when we lock a loan, we're currently requiring at minimum a verbal verification of employment or a pay stub or something to show the borrower is currently employed within 72 hours of locking the loan. So that's kind of our first one up front is we want to make sure that that's taking place. Then for underwriting purposes, we're going to whatever our AUS requirements are. So whether that's a full written verification of employment, or maybe it's just a verbal for the particular loan type. So that's kind of at that underwriting stage. Then all loans and the agency requirements are to do a 10-day verbal verification of employment. So 10 days prior to the note date, a verification of employment is always required. That's a standard guideline. And then we have added into it, additionally into that, a 48-hour. So prior to funding, a 48-hour verification of employment before we fund the loan. And back to what Andy said, most lenders are utilizing these alternate avenues if they can't get an employer on the phone. I know especially for schools, it's really tough. You know, a lot of these folks aren't able to verify. Or there's also been challenges. I know many people are familiar with things like the Work Number that do automated verifications where they only report anytime there's a new pay stub. And so they're not going to update in between pay periods, and they don't verify over the phone. There's not somebody sitting in HR that's willing to do that. So things like bank statements, most recent pay stub, those alternate forms of documentation have been really effective. Haven't seen this from our experience so far, haven't really seen this been a detriment or something that's holding people back. Maybe a little bit more of an inconvenience. We're definitely giving our clients a heads up. Let your employer know if it's a smaller company, let your owner know, or your head of HR or your direct supervisor, just let them know. We're going to be getting in touch with them, and it's super important if they can get back to us quickly.
So, Sherry talked earlier about, just how much instability there is right now. What advice do you have for borrowers who are hoping that their job's going to be there?
You want me to take that one?
Get it. Is that Andy that was that, or Jake? I'm sorry.
Have at it, Andy.
Can you repeat the question, Paul? So what advice do you have for somebody
What advice do you have? Because they're checking on verification. We know that more and more people are losing their jobs. Someone's in the process right now and they have a concern. What advice do you have for them?
I think they have to make a decision that's best for them. If they think, there's two things here. Can you buy a home and should you buy a home? And we're looking at whether or not somebody's qualified and meets the guidelines at the time they close. But you also don't want somebody to put themselves in a situation where they're expecting a layoff and then they get laid off and they're trying to move their closing up, right? In order to, let me get closed because I know all the verifications that Jake talked about is going to happen. And now let's get closed so then at least I have my house. I don't think that's
Thank you, Andy. That's exactly what I was hoping you would speak to, because I'm hearing a lot of that. Let's hurry up and get it closed, and just cautioning people that, you don't want to be house rich and life poor.
And our ask from the realtor community is that they're a second set of eyes and ears. This really, it always has been and continues to be a partnership between the lending world and the realtor world. And let us know about those types of things, because it really, it gets really expensive really fast if you start doing loans for folks that aren't going to make their mortgage payments. And when we hear things like people in the process of buying a home and asking us about what their forbearance options are on payments, that's a huge red flag, and probably not somebody that we want to lend to. And the whole forbearance and deferral and forgiveness, there's all this different information that's going on right there right now. And I think there's still a lot of uncertainty. You're seeing some of these servicers and lenders in place that's saying, okay, we're going to allow you to forbear your payments for 3 months or 6 months or whatever it might be. But what happens after that? Sometimes it's not even laid out. It's not even clear. And so there's uncertainty of, if I skip 3 payments, am I going to owe all of them as soon as that period's up? Are they going to get tacked onto the end of my loan? Am I have to do a loan modification? So it's really important that people understand their options. But more than anything, my ask to the realtor community would be, if you have concerns about your buyer not having income, losing their job, just communicate that with us. We want to help these folks get into homes as well, but we really need to know the ins and outs.
That's a great ask, and I appreciate that. And speaking about forbearance, what advice would you give for the real estate community to share with their clients that may be considering speaking with their service provider? Sherry.
So I believe we're going to add a video to our Facebook page after this webinar is over. It's a very short 3-minute video that the CFPB put out, and it really walks through the steps for forbearance. The reality of it is you are going to contact the entity where you send your payments. Where you send your payments, not where you got your loan, not your loan officer, where you send your payments. Obviously, those lines are very, very busy. Let's face it. Gosh, you know, I think the hardest thing for all of us, because we keep saying, please act with grace, please act with patience, you know, please communicate. There isn't a single one of us that doesn't want this to go back to whatever our normal was. And we certainly want to close loans, but we do all have a moral responsibility. So I would say to reach out and watch that video because it's so short and so direct, and then reach out to the person, entity that you are making your mortgage payment with, and do so ahead of time. Don't wait till the last minute because those lines are busy. Those lines are busy. So if you know you've got the problem or you're going to have it come May 1st, reach out, know what you got to do, know what you got to plan. Andy, take it away. I see you having something to add on. Please do.
Yeah, because this is unusual times. When we went through this, the recession in 2007, 8, and 9, people had to prove a hardship. These days, they don't have to. They simply have to ask, and they can have it forbeared for up to 6 months, and they could ask, and at this point, another 6 months. The temptation is there for people to ask for a forbearance who don't need it. And the system is stressed enough. The advice has to be, if you can make your payment, make your payment. Please, it's only going to add additional stress into the system and unintended consequences later. And if you need it, then take advantage of it.
Don't take all the toilet paper, people.
Please.
I know. Sherry, please go ahead.
And just adding one thing, it is forbearance. It is not called forgiveness. It is called forbearance. It's not called forgiveness. So right back to, do not take it if you do not need it. This is not a pass like I will never, ever, ever have to pay that money back.
Yeah. So Jeff, let's take us back up again to the big picture view right now. With everybody watching the markets and trying to understand what's happening, what should we be paying attention to right now?
Well,
deep breath.
It's a very open-ended question.
Well, you had them ahead of time.
I think paying attention to just sort of watching what is happening, both at your local level, your state level, and your national level. And I'm not talking so much about the finance markets. Just think about what's going on in your areas with your local governments, what's being done, it's really difficult for any of us, I think, to find what the truth is and finding reliable sources. I think, honestly, during the next 4, 6, 8 weeks, if you can find what I would consider a reliable source for information around the pandemic in and of itself, and then how your government is reacting to it, that's something to keep an eye on. I mean, to quote our president a while back, he said, the cure can't be worse than the problem. And to a certain degree, it's starting to go that direction. When you've got, 6.6 million people, new filed claims today in unemployment, those numbers are staggering. And we've got to find a way to not only combat what we're dealing with, but we've also got to find a way to kind of turn the economy back on. I mean, we on our side, we were all considered essential. The housing market in and of itself is truly the financial backbone to our country. I think we saw that 12 years ago. The good news here for all of us is values seem to be holding. And that was a major, major problem of what happened the last time through. Essentially, overnight, people were underwater on mortgages. The one positive I would say, so something to keep an eye on, is what is going on with values in the market. If values stay steady, they don't need to be appreciating right now, but if things stay steady, there is still more equity in housing today than there ever has been in the history of our country. People while it is a forbearance and not a forgiveness, people are not going to want to walk away from their houses because they have real dollars tied up in the equity of their homes. And
where would they go? They still have to go somewhere to pay rent anyway, right?
Right.
that's right. So if you decide to walk away from your house, you're still going to have to pay rent to somebody. You can't go to a new landlord and go, hey, I want to rent your place, but I got to forbear for the first 3 months. You okay with that?
Oh, you're
I mean,
going to
how's
pay
that
a mortgage. It's just either going to be yours or someone else's.
Correct.
Right.
So, I mean, to me, to kind of back to the big question, keeping an eye on what's going on in the housing market, the values, you know, you guys out in the realtor space, especially I would say more on the listing side of this, you're kind of the front edge of this, right? I mean, if you're in a neighborhood where you've listed a couple of properties and the last couple that you would call similar, I'm just throwing numbers out, were $500,000, and then all of a sudden you're in one where they're like, oh no, we're going to do this one at 450. All right, you kind of know up front, maybe things are changing a little bit. So you're not appraisers, but you're very in tune with what's going on. And that would be, I guess, my biggest takeaway for everybody to take is you guys are the front line on this. When you're taking listings, what's happening with the value against what you expected? You're getting BPOs to set values and looking at your comparables. What are you seeing? And I think that's going to lead us to where a lot of things are going to end up going.
It's supply versus demand. And right now we still have little supply and a lot of demand. So that's where we are right now with that. Jeff, thank you for those last and advice to realtors. Anybody else have something you want the realtors to take away, something you wish realtors knew?
Yeah, I would say if you're a listing agent, especially if you're a buyer's agent, you already probably trust the lender you're working with. You understand their process. If you don't, you need to understand it. To Jake's point, all companies are being impacted. Sometimes it's helpful to understand, are you an independent mortgage bank? Are you a bank, a credit union, a bank-owned mortgage company? The stresses based upon put on the company could be a little different. So if you want to go in the weeds, you can ask those questions. If you're a listing agent and a pre-qualification form comes in, I'm amazed that finally we're starting to get more questions, but I was amazed in the past you wouldn't have somebody call the lender and ask. I think you need to ask, how are you handling appraisals? Tell me about this client. You know, we can't divulge personal information. Are they in an industry that could be impacted? I mean, ask the questions, find out what you're going to be allowed to share as a mortgage lender, but I think you really need to vet the client and the mortgage company and their process.
Andy, take us through some of those questions a little bit more. Go ahead, take us through some of those, because everyone's going to be writing them down right now.
Yeah, I would ask, so as far as the down payment is, do they have, and again, some of this information might not be able to be shared. I know as a loan officer, I would ask my client in advance, are you comfortable that I share this? Because it might help you. Is your down payment in cash or does it need to be liquidated from the markets? Is their job stable? And I don't know anything about pay, but is their job stable? Tell me about how you work with appraisals. If they're making a 20% down payment, is an appraisal waiver an option? If they're not, tell me what's the timeline on appraisals? How quickly can we get this closed? Everybody has different timelines right now. And of course, people are in a hurry. That's where I'd start. I might ask, how's your company being impacted right now? Have you discontinued loan programs? Is this a program that you're concerned about? So, whatever you're—
I'm not going to annoy you as the listing agent calling you and asking you all these questions.
No, I'm going to love it.
Everybody did this.
I want my client, selfishly, I want my client to get their offer accepted. And if I'm doing my homework, I'm excited to share these things because that pre-qualification form that you put together, a lender puts together, it looks the same across the board. So ask those probing questions and figure out why you might want to take one offer over another offer.
So, we started this speaking about the due diligence that the banks really need to be doing right now, right? And at this point, we're speaking about the due diligence that the realtors and the sellers really need to be doing right now about the borrowers as well. So that's a nice circle to come back to. Sherry, last thoughts for realtors.
I would say, Andy hit on a lot of it. The other part of it is, and so did Jeff, when we talked about your first line, you're in the house, you're talking to people who want to list. You can ask that seller, anything going on in your neighborhood, anybody else thinking about selling? Not that you're looking for the business, but, do they have some sort of a stress where they might be putting their house on the market, and dropping the price? The other part of it is, as a realtor, I would definitely be checking back in with your market where you're going to take those listings, because you took it 2 weeks ago, and only because of what's going on. Maybe you can't get the same number of showings that it would have in the past. Keep your pulse on your buyer, your seller, and your market. And then, even though we as loan officers or managers or whatever, we are swamped, and remember, all of our staff has gone home, and we've turned on all of that technology from their homes. And so we're stretched and stressed, and we're hoping the internet doesn't freeze. I mean, let's be true here. I think transparency for all of us, an applaud to realtors. You guys have been virtual for a very long time, writing the contracts on your iPads we lenders have not been working from home forever. So now you have all the processors and underwriters and everybody trying to do this from home. So I really am saying to answer your question, sorry if I'm going around it, roundabout. The communication and the understanding and staying in touch. Don't let go of watching your buyer, your seller, the property. And honestly, keep encouraging everybody, because we really are all here to offer solutions and to get us through this. We will get to the other side. And together, that corny stuff, we'll be stronger, we'll be smarter, and peace will reign again. And I genuinely mean that.
I believe you are correct. Jake, what thoughts do you have for realtors that you wish they knew, or something that can help them right now?
Yeah, the last one, these guys did a great job on summarizing. I want to talk about one specific thing that Jeff briefly touched on, the appraisal part, and that's jumbo loans. A lot of people have maybe heard that jumbo loans aren't being offered anymore or discontinued, and there's a lot of truth to that. In fact, we even saw last week on Friday, Wells Fargo discontinued all jumbo loans. I saw this morning that BB&T has now discontinued all jumbo loans. There's a few factors that are coming into play here. One is part of that mortgage-backed securities. And with your normal Fannie, Freddie, FHA loans, you have a backing to those mortgage-backed securities, and you have the federal government stepping in to buy those bonds. With the jumbo loans, it's all private mortgage-backed securities. So you're not getting some of that relief, which was the first thing to really decimate that market. Additional factors that you have coming into play are typically that jumbo borrower or home buyer. A lot of times they're self-employed, whose businesses are being greatly impacted. We all know that small businesses are greatly impacted. And a lot of times their assets are coming from the market, from stocks and equities and mutual funds, and those have been greatly impacted. So you've got all these different outside forces that are coming into play that are making it really difficult to even find outlets for some of those jumbo borrowers. Most of what you're going to find is going to be very vanilla, high FICO score, at least 20% down. But there are other options. We're seeing the combo loans come into play, where you've got a max conforming first loan, which is $510,400, by the way, Jeff.
Thank you.
and then maybe an equity line or a second mortgage or something like that coming in behind it. So there are still some options out there. If you are talking to clients in that market, definitely still get them over to your lending partner. And there's also been a lot of communication amongst all of us. I know that I'm in talks now more than ever with my peers that are working at Prime and Fairway and Nova Home Loans and the credit unions, and we're all talking amongst each other and want to help each other during this time, because we're all in it together. So we're all willing to help and chip in. But that was kind of the last. I know we had a lot of questions about the jumbo stuff and want to make sure we covered that.
We did. I think that we've gotten through almost all the questions. I want to check with Brittany real quick just to see where we are, if there's any glaring, gaping holes that I left or any questions that were lingering out there, Miss Britt.
No, I think you covered them. Once we post this, we'll see if we get any other questions, and then we'll compile them and email them to you all and hopefully get some responses to give back to the members.
That sounds just great. I just want to wrap up some of the things that I've heard you guys say repeatedly. I was taking little notes as we were going along. Some of the key points, the big takeaways are everyone has been affected by this. and we are all in this together. I think I heard each of you say that multiple times. Jeff spoke a lot about making sure that when you're checking out facts, whether it's regarding COVID or what's happening with your local government, that you are using reliable sources. And just to be clear, Jeff does not mean your friend's Facebook post when he is saying a reliable source. Right, Jeff? That's not what you mean?
That is not exact. Yes, you said that perfectly.
We're talking about going through the CDC website. Oh, go ahead, Jake. What's up?
Unless if Jeff posts, then it's true.
Unless Jeff is your friend, right? And it's his post. But truly, friends, and with that, just a caution too, when you're sharing information, make sure that you're checking the validity of that information prior to sharing it. With that, Sherry spoke a lot about grace and the importance of transparency at this time. Listen, if things are not coming together, it's best that we all be clear about that and be honest with one another, because although it might not seem clear to you, maybe Sherry, Jake, Jeff, or Andy have a solution. They've seen this problem before. So having that great communication all throughout, which was the last and most important point that I think you have all made, is making sure that you have a lot of communication throughout this entire process. All right. Any other points that you all want to share? No, just giving thumbs up.
Nice job.
Yep.
Thank you,
Thank
Paula.
you all so much for being
Thank you.
here. I could talk to you guys for another 5 hours, but nobody would watch that long.
Thank you, Paula.
On behalf of all the members of Arizona, we truly appreciate you all taking your time for us realtors. Thank you very much.
Thank
Bye,
you,
everybody.
guys.
So long.
Pleasure.
Have fun.
See you guys.
Bye.
Bye, everybody.